Did you ever stop to consider the risks lurking in the current stock market? In the world of investments, it's easy to be swept away by the allure of high returns. But let's not forget that the stock market is a game of speculation, where fortunes can be made or lost in the blink of an eye. It's a playing field that's as unpredictable as the weather, where even the most experienced investors can be caught off guard. Market risk, the possibility that the overall market will go down, is an inherent part of investing. One day you're riding high on a bull market, and the next, you're caught in the whirlwind of a bear market. Now consider this. What if the market isn't just going through a routine cycle? What if we're on the brink of a major downturn? As history has shown us, the stock market is not always as stable as it appears. Let's take a trip down memory lane, shall we? Remember the dot-com bubble, the housing bubble? To understand the current market situation, it's helpful to look back at historical bubbles. A bubble, in economic terms, is a situation where the price of an asset exceeds its intrinsic value by a significant margin, often due to excessive demand, speculation, or exuberant behavior. Let's take the dot-com bubble of the late 90s as an example. This was a period when internet-based companies, the so-called dot-coms, were the latest rage in the stock market. Their stocks were skyrocketing, even though most of these companies were not profitable. The bubble grew bigger and bigger, fueled by the belief that the internet was the future and these companies would soon start making huge profits. But eventually, reality set in. Many of these companies went bankrupt, and the bubble burst, leading to a significant market downturn. Then there was the housing bubble of the mid-2000s. Housing prices were soaring again, not because of any intrinsic value in the houses, but because of speculation and the belief that housing prices would continue to rise indefinitely. When the bubble burst, it led to the Great Recession, one of the worst economic downturns in recent history. In both these cases, the aftermath of the bubble bursting was severe. The bigger and broader the bubble, the longer and more painful the aftermath. Investors lost huge amounts of money, people lost their jobs, and the economy took a long time to recover. So why are we talking about this now? Well, some experts like Jeremy Grantham believe that we are currently in a bubble. The US stock market, they argue, is significantly overpriced. And if they're right, and the bubble bursts, the aftermath could be as bad, if not worse, than the dot-com crash or the housing crash. And as history repeats itself, we might be on the brink of another bubble. Jeremy Grantham, a renowned investor, has sounded the alarm. A notable figure in the financial world, Grantham has built a reputation for spotting market bubbles before they burst. This time, he's warning us about the US stock market. According to him, it's not just overpriced, it's significantly overpriced. Grantham sees signs of a bubble that's not just big but broad as well. A kind of bubble that, when it bursts, could lead to a downturn that's not just long but painful too. A downturn that, in his view, could see the market collapse by as much as 60%. That's a drop that would make it the worst market crash since the Great Depression. To understand why Grantham is so concerned, let's look at one of the tools he uses to evaluate market valuations, the Shiller P/E ratio. This metric is currently indicating that the US stock market is overvalued. Not just a little overvalued, but more overvalued than it was before the 1929 crash. Grantham points out another worrying trend: the unusually high profit margins of US companies. These profit margins, in his view, are unsustainable. When they inevitably revert to more normal levels, the market could experience a severe downturn, a downturn that could be even more painful because of the inflated prices of US assets. Grantham's not just sounding the alarm, he's also offering a possible solution. He suggests that investors might find safer havens in non-US equities. These haven't experienced the same level of price inflation as US assets, which might make them a safer bet in the event of a market crash. Grantham's warning is clear: the current market situation is unsustainable. It's a warning that should give all of us pause. Whether you're an investor, a business owner, or just someone concerned about the future of the economy, it's worth taking the time to understand what Grantham is saying and consider what it might mean for you. So, what does Grantham suggest we do in the face of this impending collapse? You might be wondering. Well, the seasoned investor has some advice for those who are willing to listen. Grantham believes that looking beyond the borders of the United States may be a wise decision. He suggests that investors consider non-US equities as a potential shelter from the storm. The rationale behind this advice is based on the observation that these markets have not experienced the same level of price inflation as US assets. In other words, they're not as overpriced, according to Grantham. But why might this be a better option? Well, when a bubble bursts, as Grantham is predicting, the assets that are most inflated tend to suffer the most. As we've mentioned, the US stock market appears, at least by some measures, to be significantly overvalued. This could mean that US stocks are at a higher risk of a significant price drop if a market crash occurs. On the other hand, non-US equities, having not been subject to the same degree of price inflation, may be less vulnerable in the face of a market downturn. This doesn't mean they're immune to a crash, of course, but they could potentially offer a safer haven for investors looking to protect their assets. However, it's important to note that investing in non-US equities comes with its own set of risks. Currency fluctuations, political instability, and differing economic factors are just a few examples of the considerations that need to be taken into account. So, while Grantham's advice may be worth considering, it's crucial to do your own research and consult with a financial advisor before making any significant investment decisions. In the end, the choice is yours. But remember, informed decisions are always the best decisions.